Mhm.
When you think about per capita, think about standard of living of yourself or the average individual in Canada. Used to be equal with the United States. Today, after the last 10 years, Canada's per capita GDP is between 28th and 33rd in the world, from third in the world. And the amount of money that we make vis-a-vis an American is just $56,000 in US dollars versus 89,000 for the average person in the US as a whole. If you look at Ontario, which is one of Canada's richest provinces, it is a GDP equal to the poorest state now in the United States, which is Mississippi. But a starker contrast, and this one sort of hit home in looking at this a few months ago. British Columbia's per capita GDP is just $56,000. Just cross the border into Washington State, and the per capita GDP there is double that of BC at $108,000. Yet, if you can believe it, and this is the kicker, the top marginal personal income tax rate in Washington State is just 37%. And in BC, it's 53%. So we make half as much money as they do, and we're taxed 30%, 30% more.
Very pleased to welcome back to the show Neil McIver, McIver Capital. Neil, first of all, great to have you with us. And you know what I'm going to start with? Sorry, I'm throwing out a left field at you, but you were on our show, oh gosh, just a few months ago. It was April. And
Yes.
You were talking about your Vancouver Growth Portfolio. I just want to tell you, because I'm a performance guy, it's up 26%. And that's after all the costs. And if you go back to when you launched it, I know it's bigger than that. It's about 33%. But I just wanted to say, on Money Talks, we try and make money.
Yes.
We give good advice. So I want to first of all say thank you and give you a pat on the back. I mean, seriously, that's spectacular performance. Tell me a little bit what you do in I'll get to some other stuff, but tell me a little bit more about the Vancouver Growth Portfolio.
For sure. Well, and thanks, Michael, for having me on, and great to join you and all of your listeners and viewers today as well, too. Yeah, the Vancouver Growth Portfolio, we actually developed starting back about 8 years ago. And really, it was just a pro portfolio for us here at McIver Capital Management internally. And these were just great ideas that we were tracking for our primary models, which is what we're famous for, which are very scientifically and sophisticatedly structured to reduce risk. And these are just great ideas that just didn't fit that model. And we wanted to invest in them internally. So we built a portfolio of those ideas that we've been tracking, and then we invested in it ourselves. We funded it ourselves, and we ran it for ourselves for a number of years. And basically, it was an all growth portfolio where we didn't really concern ourselves with any risk whatsoever. These were not irresponsible positions. They were positions that were great companies, but maybe they were a hair before they were profitable, or they were at valuations that were a little bit elevated. And we did extremely well with it. We eventually expanded that out to friends and family, and then eventually to existing clients. And then right here on your Money Talks show, we launched it live. I think Victor was in that day, the day that I appeared. It was almost exactly 1 year ago that we launched the Vancouver Growth Portfolio. We later spoke about it at your World Outlook conference as well, too. And since that point in time, I think the rate of return, 32.88%. Net to client, that's net to your back pocket since that point in time. And then I joined you again in April, and in the middle of a tariff chaos, and I was arguing that clearly this relatively temporary issue would be settled, and the building blocks of a great economy were there, and buying generational opportunities, in structurally growing sectors made sense. And since that point in April to now, in less than 6 months, 25.95%, 26% in the portfolio, again, net to clients. And in the portfolio, we focus on very specific parts of the economy. We're not owning banks. We're not trying to build a balanced structure to the portfolio. We're looking at AI, robotics, nuclear energy, cybersecurity, the digital economy, traditional hydrocarbons, and defense, and companies that benefit from geopolitical uncertainty, because these are the generational opportunities in the structurally growing sectors into the future. And that's what we've done, and that's what we focused on. And the Vancouver Growth Portfolio is, in effect, it's a hedge fund-like investment, although it has daily liquidity for investors. So we can get in and out. It's you own positions individually, and it's got a minimum of just $250,000 to access it. And normally it's $1 million to access the work that we do. And but based upon your input and that of your team, we wanted to lower that to make sure that everybody had an opportunity to get in on the great stuff that's taking place in the world today.
Let me take another step here. I mean, and of course it's contentious because we've got a lot of emotions involved in our U.S.-Canada relations. We just had the U.S. ambassador say, they were troubled by the anti-Americanism, and the response was, "When stop saying you're going to annex us as a 51st state, and that'll help." So emotions are very high. But in finance, emotions are not a good thing. Dollars and cents are a good thing. Practicality is a good thing. Neil, let me just say, I mean, again, at our Outlook conference for several years, we have preferred the U.S. market. And I'm looking at things like, look at how much we spend on our workers compared to the States. It's a fraction. The U.S., per capita, capital investment is much higher. So you guys have also, that's where you have emphasized. And I want just to comment on that environment today.
Absolutely. Look, we do own Canadian equities. There are good things to own in Canada. I don't want to be too negative or put investors off too much, but and largely those areas are value stocks. That's really where Canada is today. There's some reasonable opportunities there, but growth is something entirely different. And the Canadian economy largely is in desperate shape. And this is far less to do with external issues and pressures, and more to do with the internal direction politically that we're going down today. And that goes from a national level all the way down to a provincial level, and even to a municipal level in many cases. And the economic decay we're experiencing now in the country is not just the result of decisions made since the last election or the current prime minister. And I'll remain politely optimistic with the words that are coming out of his mouth about the direction. But these are the results of policies that have taken place over the last 10 years. And you saw the desperate letter, really a plea for help from the 69 Canadian energy sector CEOs that sent to the Prime Minister this letter last week, pleading for help to help move this economy forward. Canada economically has largely been paralyzed by political decisions that have effectively frozen our natural resources in the ground, be it mining and minerals to precious metals or extracting hydrocarbons such as natural gas and oil, and related net zero political decisions that will eventually kill our auto jobs and that sector and many others, and ship those jobs over to China unless people take a step back and understand what's happening. And you combine this with high business taxes in Canada. Look, in Canada, business taxes are 30-40% depending upon how you address that. In the United States, they're 21%, going down to 15% if you manufacture in the US. And then you add into this personal income taxes that are amongst the highest in the G7. And I've got some data that way if you wanted to go through that. But it's pretty eye-watering to take a look at how we're hammered. And you add all this together, and literally billions of investment dollars have flown out of Canada over the last number of years, 120 billion in the last 12 months alone. And that's a conservative number. And that's really as investors and innovators and entrepreneurs have finally started capitulating and giving up. And Canada lost just over the last 2 months, 77,000 jobs alone. And most of those, according to Stats Canada, in the professional, scientific, and technical services area of the economy. Those are the people that we need to grow this economy. And the only job gains, and again, it was net $77,000 people have left their jobs, were in fast food and government. So, from our perspective, and look, most of our clients are business owners and significantly wealthy individuals that have means and are mobile. And I cannot tell you the number of them that are looking to take their businesses out of Canada and primarily to the US. It's unprecedented in my 30 years, the number of people that have just really thrown up their hand. And, you contrast Canada's economic position of that of the States, we're losing hundreds of billions of dollars of investment capital over the past number of years. The US has not only gained billions into their investment markets, but anywhere between 6.5 trillion and 12 trillion into the direct capital investment in manufacturing in the United States. And that's onshoring of manufacturing. Hyundai, $20 billion. Apple, $60 billion. Taiwan Semiconductor, $100 billion. The numbers are off the charts, and all of that is going to build a whirlwind of an economy, and you can see that directly in Canada's GDP, which is sliding backwards. We're negative 1.6% annualized over the last quarter, which, if that continues, it means that we are already in a recession. And then you take a look at the U.S., and I believe they just revised it upwards to positive 3.5% annualized. That's ripping in economic terms when you take a look at GDP growth.
Well, it's interesting. I mean, one of my observations has been that people have different priorities, and what a surprise that I do think that the economy is important. I care about the vulnerable people in society. Well, you don't help them with a weak economy. I care about the future for our younger generation. We don't help them with a weaker economy. The exodus is absolutely there to observe for all to say, but I think it's important to acknowledge there's millions of Canadians, tens of millions, where this is not a priority. But for those who want to protect themselves, and they will have to protect themselves further. They've already seen it, with food prices up. I'm not blaming the government only. There's many factors, but 27% in 4 years. We've seen what's, the challenges in the housing market. For that, I will blame 3 levels of government. The point is, you're on your own as far as I'm concerned. Don't want to put words in your mouth, but this is why they have to protect themselves. And I don't see, there's no reason other than wishful thinking to think this is going to change. And I appreciate Prime Minister Carney has walked into this, but of course he's got many of the same players on his team. And I don't see, this is my criticism again, everyone, it's not Neil's. I don't see a sense of urgency at all. I think the things you just described should be a flashing red light. We can't go further. Our reputation as a place to invest has been declining. But here's the thing that I love that you brought up. We're in competition for capital. We're getting killed by the U.S. Doesn't matter what you think. I'm telling you, people with major money don't go, geez, I don't like Donald Trump, so I don't think I'll choose that. That's ridiculous. It's a dollars and cents decision. So let's go back to where you're focusing. That's a great rationale for why you have to look at the U.S. There are things to look at in Canada. We're always looking for good value, but the U.S. market still provides, especially from that corporate competitiveness, a much easier environment.
It does, absolutely. I mean, the velocity of capital through their economy, there's a whole host of reasons why the U.S. is a far more attractive marketplace. I mean, you take a look at personal and corporate income taxes, and they're far lower in the U.S. I mean, I'll give you an amazing stat or amazing piece of information, but Canada's GDP, per capita GDP. That's really when you think about per capita, think about standard of living of yourself or the average individual in Canada. Used to be equal with the United States. Today, after the last 10 years, Canada's per capita GDP is between 28th and 33rd in the world, from 3rd in the world. And the amount of money that we make vis-a-vis an American is just $56,000 in US dollars versus $89,000 for the average person in the US as a whole. If you look at Ontario, which is one of Canada's richest provinces, it is a GDP equal to the poorest state now in the United States, which is Mississippi. But a starker contrast, and this one sort of hit home in looking at this a few months ago. British Columbia's per capita GDP is just $56,000. Just cross the border into Washington State, and the per capita GDP there is double that of BC at $108,000. Yet, if you can believe it, and this is the kicker, the top marginal personal income tax rate in Washington State is just 37%. And in BC, it's 53%. So we make half as much money as they do, and we're taxed 30% more. So there's a whole host of reasons that we want to look south of the border. But a significant problem, and you brought it up, and I think you did an excellent job of it, is that most Canadians overweight Canadian equities. And it's a significant problem we see all the time in investment portfolios. And and this goes beyond the current issues that Canada right now is a bit of an economic sandcastle as the tide is rising while the U.S. is building an economic fortress. But the U.S. market has historically outperformed the TSX because of its relative dynamism. It's the fact that taxes have generally been lower, and the fact that it's more business is more insulated from government overreach and regulation. And these numbers, the numbers don't lie. I mean, the long-term rate of return of the TSX is 7.9%. For the S&P 500, it's 9.8%. So that simple fact will tell you that we want to be south of the border for sure. But most Canadians invest through banks, and they often have very restrictive approved buy lists for brokers and investment products that they heavily weight into Canadian equities. And surprise, surprise, most of those investments are the clients of the banks themselves. And this is a shame. Canadian investors don't have to put up with it. There's no longer any rules. Remember the old rules, Michael, inside of RSPs, 20%. It could be foreign, 80% had to be Canadian. There's no rules about Canadian content in RSPs or TFSAs. And with new technology related to, the exploding nuclear energy sector, AI, robotics, and cybersecurity, and the revolution of blockchain, all that's happening in the U.S. That innovation isn't taking place here in Canada. You got to go down and be a part of it. You just have to go down and be a part of that. You may be trapped here for a number of different reasons, and I don't want to say trapped. I'm a very proud Canadian, but you would economically, you can go down and get a piece of that. And I think every Canadian should. It behooves you to go down and do that.
Let me finish with asking you about this. You have a webinar coming up on Tuesday, September 23rd. It's at 10:30 a.m. Pacific time, and people should tune in for that. And I'll give them more information. We'll put it up on mikesmoneytalks.ca. We'll put it on our social media. But that's Tuesday coming up, at 10:30 Pacific. Just give me a very quick rundown. What are you going to cover in that?
Well, we're going to go through all the Vancouver Growth Portfolio, or the VGP, and we'll be going through the opportunity in detail, how the portfolio itself is structured, and what we see over the next 1, 2, and 3 years, and answer any questions that people may have. And I also want to say this: we've obviously had terrific results since this portfolio has been launched to the public through you over the past year. But the portfolio itself has been around for 8 years, and the long-term track record of the portfolio is about 14% net to client in your pocket annualized over those 8 years, and it's accelerating. But that we're just beginning to a great extent because of these various revolutions that are happening down in the United States. We've already taken profits on a lot of the positions that we've owned over the last year, and we've very recently reloaded, and we're continuing to reload that portfolio in order to take advantage of the next 1, 2, and 3 years.
Well, it's going to be interesting. That's Tuesday coming up, by the way, 10:30 a.m. We'll put more information. In the meantime, I know you're busy, Neil. We appreciate you finding time for us again.
It's been my pleasure, and thank you for the opportunity.